and welcome to the Hash. It's Monday. We are here to talk about what is going on in crypto land. Naomi, you are Naomi Brockwell. You have the first story of the day. I am Zach Seward. That's David Morris. There's Jen Sanasi. Let's do this thing. Naomi, all you.
I am Naomi Brockwell, and I do have the first story. And we're going to be talking about something that Vitalik Buterin said recently in a Reddit forum, something that caused a lot of stir amongst the crypto community. He says that the mandatory acceptance of Bitcoin in El Salvador is counter to crypto's ideals of freedom. This is something we've actually talked about a lot on the show. There seem to be these two camps of people. One is just blindly cheering anything that happens in El Salvador because they really like Bitcoin, and the other side saying, actually, we don't like coercion and force, and it's counter to the ethos of cryptocurrency. And, you know, Bitcoin aside, the mandatory acceptance of it is not okay. So let's read what Vitalik actually said. He said it in this Reddit forum. He says, "Nothing unpopular about this opinion. Making it mandatory for businesses to accept a specific cryptocurrency is contrary to the ideals of freedom that are supposed to be so important to the crypto space. Additionally, this tactic of pushing BTC to millions of people in El Salvador at the same time with almost no attempt at prior education is reckless and risks a large number of innocent people getting hacked or scammed. Shame on everyone." Okay, fine. I'll call out the main people responsible. Shame on Bitcoin maximalists who are uncritically praising him. So some pretty strong words there. I'm going to throw it straight to the group for your take on all of this. I definitely have some thoughts, but Jen, I'll throw it to you to start off with. What's your take?
Yeah, I totally agree with Vitalik when it comes to education. That's something we've spoken about a lot on the show. You know, a lot of the people in El Salvador, this is the very first time that they've been exposed to Bitcoin. And so to launch this project and say, actually, you have to use this if you're a merchant, big or small, and if you don't, you'll be faced with repercussions from the law is absolutely ridiculous. The article, though, points to some confusion. So we're talking about Article 7, which says all merchants need to accept Bitcoin no matter what. But then the president tweeted, I think last month, saying Article 7 is actually, you know, don't pay attention to it anymore. If you don't want to accept Bitcoin, it's no big deal. So in the article, there's actually a quote from a Salvadorian merchant saying, well, the law is one thing and Twitter is another. That's not a direct quote, but that's also something we've spoken about on the show. And so I can only imagine how merchants in El Salvador feel. You know, if it's written in law, I would probably abide by that rather than what the president's saying on Twitter. So this just brought up a whole bunch of confusion for me. I would really love to see Article 7 be abolished or at least changed. But Naomi, I see you nodding away there. I can either toss it back to you or David, did you have your hand up?
Yeah. So I guess I kind of have a middle ground position here. And I think that one of the things that maybe gets excluded from these conversations is that the definition of legal tender is that everybody accepts it. So if you're talking about the legal, no, I mean, this is what happens when you have a dollar and everybody has to take a dollar. So I do wonder if there's a gap there. But Naomi, you seem to be disagreeing. Are you?
Yeah. And I think that's a big confusion in the crypto space. So in the United States, for example, there is no law saying that at your business, you can't put up a sign that says Bitcoin only. In El Salvador, prior to this law, you could also, it was perfectly legal for you to put up a sign that says Bitcoin only on your store. So legal tender does not equal coerced tender. And I think that's an important distinction. So in the US, I could put up a store that says US dollar cash only. I could put up a sign that says, you know, euros only in cash. I could put up a sign that says card only. These are all perfectly legal. What El Salvador has done is actually something slightly different. Article 7 is quite a rare thing that very few countries have actually adopted that says if someone offers this to you at a point of sale transaction, you must accept it, which actually isn't the case with most places around the world and isn't a part of legal tender laws as they're, you know, normally done across the world at all. So I think that that's one of the main confusions that you brought up, Jen, is that, you know, there's this strange idea about like legal tender laws and coercion and people saying, well, people were already forced to accept the US dollars. It's like, well, actually, it's just not true. People could have put up signs and said, you know, they accept Bitcoin prior to this. The other point of confusion.
I get to be incorrect every couple of years, so that's my one.
I think, well, we all do, David. But the other thing that is confusing about all of this is that people are saying it's kind of this Orwellian doublespeak, where they're saying, one side saying, well, people must accept Bitcoin, and then the other side saying, no, they don't have to accept it. They can exchange it for anything they want. And you've got to break apart those two parts of the sentence because they're total non sequiturs. Accepting something and being able to trade it for something are two separate steps, right? Yes, they have to accept Bitcoin if they're offered at a point of sale transaction, as per Article 7. Yes, they can immediately transfer it. No one's debating that they can immediately transfer it. But a lot of the Bitcoin community is using the second step to say it doesn't matter about the coercion because, they can immediately transfer it. But the point of the coercion that has a lot of people up in arms is, first of all, as Vitalik pointed out, forcing a business to accept a specific cryptocurrency is counter to the ethos of cryptocurrency, the ideal of freedom in money. But also there's the point of, all of the hassles involved, in order to exchange it. Like, first of all, you have to have an app that's set up. There's a technological barrier there. Perhaps people don't want a digital implementation of US dollars. Perhaps they don't want that. Perhaps they don't want to go into a system that's KYC'd. There are all kinds of things that go along with this. Perhaps they just want cash right at that moment. And if someone offers them Bitcoin, they're legally obliged to actually accept that Bitcoin instead of the cash. So it is coercion, no matter which way you look at it. And I don't think anyone should be cheering with this. So I'm completely on board with Vitalik. But, it's like people like Eric Voorhees have also tweeted about this and said, there are two things going on. Bitcoin is being propagated around the world and is going to be propagated by good people and bad people. And it's great that Bitcoin is being propagated, but we also have to look, we don't necessarily have to cheer the El Salvadorian government, for what they're doing. I think that what the crypto community is doing wrong is blindly cheering them and kind of whitewashing what they're doing. Let's actually acknowledge what they're doing, which is coercion, and it's an authoritarian regime. Let's also, be happy that Bitcoin is around the world, but, the ends doesn't justify the means to a lot of cryptocurrency enthusiasts. But David, I'll throw it back to you.
Yeah, so just to kind of complete these, hopefully more correct half of my thought, the leaving aside the sort of crypto values and coercion element, I do think if you look at it from a kind of adoption curve perspective, where maybe this is not something that they want people to be able to do tomorrow, but it's something they want people to be able to do a year or two from now, and they're going to approach enforcement from that perspective. It is important to remember that if you have a group of people who are using the same currency, that there is a certain network effect that you want to achieve so that it's easy for them to trade amongst themselves. So I agree that the coercive elements of this, to whatever degree that's accurate, are incorrect or shouldn't be praised. But a mechanism of some sort for getting people on board the system so that everybody is actually able to exchange with each other from a purely practical, non-ideological perspective does have to be acknowledged as something that might have some necessity rather than whether or not it's good.
Yeah, I agree with that, David. I do see the practical implementation of that being a good thing. I think like where Vitalik's coming from, obviously he's coming from the principled standpoint is coercion, ends doesn't justify the means there. And, a lot of people would say if Bitcoin can stand on its own merits, then there should be no coercion needed. If this is something that a lot of people see value in, then you'll get those network effects. You're already getting that in certain areas of the crypto community where you have good network effects. You don't need coercion. And honestly, I think that Bitcoin maxis are doing themselves a disservice by holding to this coercion side of things, saying that it's okay. Like Bitcoin could stand on its own two legs. It may take longer, but it totally could. And that would be a much better route for everyone, I think. But Zach, I'm going to throw it to you for the next story. Some interesting things going on with Paradigm.
Yeah, little scoop out of CoinDesk's Ian Allison this morning. According to an investor deck seen by Ian Allison, Paradigm, which is helmed by Fred Ursum, Coinbase co-founder, is raising a $1.5 billion venture fund for both early and late stage crypto projects. This would put it right up there near the top of the list in terms of fund size, closely rivaling, maybe not quite rivaling, but almost there toward A16Z's $2.2 billion crypto fund that was announced earlier this year. So yeah, the state of VC in crypto is really accelerating at a crazy pace, and this represents further acceleration should this be closed come next month and announced at that time. So interesting to see this Paradigm really shaping up as one of the top 2-3 crypto VCs in the space. And if they have this big fresh war chest. It's going to be interesting to see where they spread their bets going forward. I'm going to toss this straight to David for a VC take. When you see Paradigm, when you see Fred Ursum raising big, what are your initial thoughts?
I have very complicated feelings about venture capital in general.
That's why I threw it to you.
I mean, it's all about a boom bust cycle. It's all about like funding large amounts of failure so that you get a few successes. That is just how it works. And so these big VC funds have some inherent advantages. I mean, I do, I'm glad that there are alternatives out there. Obviously, A16Z has investments in Coinbase itself, but I wonder about the relationship between a fund this big and Coinbase as the largest trading platform, which has its own agenda. And, I don't know, obviously, what Ursum's motives are sort of materially relative to Coinbase, but it does, it could be used in certain ways to shape things to Coinbase's advantages. And so I wonder about that. But, in general, more broadly, the VC upswing that we continue to see, and Naomi, you probably have something to say about this, but it's so hard to separate from the macro situation because there is all this easy money. There are people who are looking for investments where they're, going to get some kind of gain versus, there's so few opportunities for that out there. So, I mean, you can look at this and see it as a positive trend line for crypto, obviously, but I do think it's important to keep in context of that larger context where, money is just easy, money is cheap. There's huge amounts of VC going around everywhere. So this is not, 100% just a W for crypto.
Yeah. And on that note, David, because I completely agree, the macro side of things plays a big role, not just in the side of people have a lot of money that they're throwing around, and they're also looking to kind of mitigate some of the losses of just having balances in cash. They're looking for things with gains. But I also think that because of the bad monetary policy of a lot of governments around the world, in particular the US government, I think that there's just increasing interest in this decentralized world of finance, in a world where you don't have monetary policy dictated by a certain few. You have it baked into a protocol. You have it written in code. You have it determined by mathematics. And I do think that that is definitely an interesting paradigm shift that more people are looking to, especially in the VC world, especially if they're looking for stability, which seems counter to everything we've seen in crypto history, where volatility in crypto is absolutely crazy. But we forget that fiat currencies around the world also have tremendous amounts of volatility as well. You see what's going on in Lebanon, you see what's going on in Argentina and Venezuela, even the ruble. Every now and again, you'll just get like a, several digit percentage fall in the value. And these currencies fluctuate a lot more than people like to realize. And especially as monetary policy becomes all the more unpredictable in the US, with the US government doing incredibly experimental monetary policy right now, printing unprecedented amounts of money, people are just not sure what comes next. And they're wondering whether it's a safer bet to be looking at things that are baked into code. So it's kind of a double-fold thing going on that you mentioned. It's very interesting. But Zach, I'll throw it back to you for your thoughts.
Yeah, I mean, so it is really interesting. And I think you're right? These are limited partners. These are family offices, wealthy individuals who have money. They exist in a low interest world, and they're looking for a way to maximize those gains. And if, Paradigm invests in the next Coinbase and, you 100x that one investment, you strike out 3 out of 4 times outside of that, it's still worthy upside for some of these investors who really do want to capture the next Coinbase. Now, it should be noted that Ursum, he's no longer active at Coinbase, but Paradigm, the fund itself, has been a key backer of decentralized finance players such as Uniswap and others who are kind of building this next crop, this next wave of decentralized exchanges and other decentralized technologies that, could be really transformative down the line. So the fact that they're raising this big fund in the relative wake of the A16Z also raising a really big fund suggests that the appetite is there among the family offices of the Bay Area and beyond. I'll toss this to you, Jen, for your last word, and then we're going to tease the break.
Yeah, just before the break, I wanted to say, I really do think this is a big W for crypto. I don't think anyone was as enthusiastic as I wanted to be. So I wanted to take us into the break, just saying that it's awesome that this money is going to go to crypto firms so that we can continue innovating in the space. And I think it's pretty obvious that VCs see the trend that is happening in crypto, and they want to put their money there. So just a little optimistic take before we
and just to really quickly echo that, it's also great for people who have skills and talent and background. Go get that money.
Get that money. W's all around, West Side for life. All right, let's take a break. We're going to take it to, we're going to throw up some gang signs, and we are going to go to the break. It's the Hash. Bloods and Crips next.
Show.
After that, hey, let's rent some NFTs. If you rent an NFT, you can get perks from that. And now there's a startup that's trying to cater to this potentially promising crypto niche. All right, stick with us. It's the Hash. We'll be back in a minute. Bye now.
CoinDesk Indexes, the market standard for crypto assets since 2014. Our trusted data powers billions in publicly traded funds. CoinDesk Indexes are the standard used by institutions, and they're the key for investors looking to understand and access crypto markets.
CoinDesk Bitcoin Price Index, XBX, has been instrumental to Grayscale, enabling investors around the world to access Bitcoin through a regulated, familiar product.
CoinDesk Indexes enabled the early adopters to build crypto investment vehicles, and they're already trusted by a new generation of global investors.
We are back. And next up, we have a story about some genuine forward motion on an idea that has been talked about in the abstract for a long time, decentralized identity. And we have just, I think, about a month ago, an RFP was awarded by the Ethereum Foundation and Ethereum Name Service to a company called Spruce Systems, which is a spin out of Consensus, or at least some former Consensus workers, to figure out how to use your Ethereum wallet to sign into services across the web. For people who, this is significant kind of because people are worried about using Facebook and Google and other centralized services, which often use their login services to gather information about you. And in theory, this sign in with Ethereum could become the root of a decentralized system that would allow you to have more control about what information about yourself you share with a particular service. This is baby steps, early stages, but it is really promising and interesting. Who wants to dive in about the significance of this? Anyone?
I'll kick it off.
Jen.
Go for it,
Jen wins.
Sorry, Naomi. David, I just want to say the article started off very sobering. I mean, you really pointed out what happens to your data and your information when you use these third-party services to log into different accounts. And what stuck out to me is, I know, Naomi, you're probably going to fight me on this, but I think the average everyday person, when they get to a login screen and they want to access information quickly, they don't think about the implication of signing in with Facebook or signing in with Google or signing in with Apple. They just want to access that information quickly and move on with their day. Maybe they have kids, maybe they have to get back to their job. They have other things to worry about. And so I think that there are more and more stories coming out, especially the latter part of this year, that are showing these people what happens to their data when they make these quick, 1-second decisions. And so this is really awesome. I'm really excited to see what comes of it. I really also love that they're starting small with social media logins. I think we can all imagine how this could go horribly wrong with the wrong code or some sort of hack. So I love that they're starting with social media logins. They can work out all the kinks and bugs and get this up and running so that we don't need to use all of our personal information to access the sites we love. But Naomi, I'll pass it back up to you.
Yeah, I will. I'll actually concur with what you're saying, Jen. Not going to fight you. I know I have quite the reputation for fighting people on this show, but I 100% agree. People are looking for the easy way to sign into these services. That's why people rarely create unique logins. They're just going to go with the button that already allows them to automatically enter a site using Facebook or Twitter or Google or whatever else they want to sign in with. So I do think the decentralized identity systems are a really interesting idea. I love the idea that you can choose what information you give out so that you can control your data and just give out certain information so that, your login details don't have to be tied with all this information. If a company doesn't need your birth date, you don't have to give it. If they don't need your home address, you don't have to give it. All of this stuff is information we freely give out. I will just give kind of a disclaimer when we're talking about this data being collected on us. These digital identity systems are not a silver bullet. They are one piece of the puzzle. I think they're a necessary piece, and I think it's important that people stop using things like Facebook to log in. But Facebook has so many other ways to track you online. Don't think that this is going to stop that. There are all kinds of cookies that are following you around on every site you visit. There's web browser fingerprinting that goes on, so people know exactly what plugins are, on your computer. They know exactly how big your browser window is. All of that stuff is used to track you as you move across the internet and say, oh, this is the same person because this is a unique fingerprint. I'm sure that it's very rare to find two people who have the exact same browser setup as anyone else. So this stuff is used to track people. So, digital identity systems, when it comes to decentralized methods of doing this, are not an easy fix. There are so many layers that you have to be focused on when it comes to protecting your privacy, but definitely a step in the right direction. But David, I think I saw your hand go up.
Yeah, first of all, thank you. I learned a new scary thing just now, Naomi. I was not familiar with the idea of a browser fingerprint. That is terrifying.
Naomi will teach you all the scary things.
But I just thought, since you mentioned the thing about birth dates, Naomi, I would sort of take a second to be a little bit more specific about how these things work and how cool they can be. Because literally, you can just give a service your birthday without even giving them your name. And it's, a lot of it is theoretical, but you could, for example, take your state-issued driver's license, which has a verified birth date on it, put that into some sort of storage system, and then use potentially a zero-knowledge proof that would be able to attest to your date of birth without including all of the information on that driver's license. So that's just one very high-level rough example, and you can kind of tell that requires a lot of building out. There's a lot more to be done, but that is the kind of world that they're aiming for. Naomi, you had something.
Yeah, I just want to add in to what you're saying, David, because zero-knowledge proofs are so important and so exciting when it comes to this stuff. Have you guys, all these sites that we have to KYC for, does it make anyone else's hair stand on end to hand over your driver's license that has your name and your birth date and your home address, and you don't even know how they're storing this stuff? You don't know whether this exchange is encrypting all this information at rest or who has access to it. All of this data is out there. It's incredibly scary how much information we just willingly give out there. And if you emailed that, I recently had an exchange write to me and say, hey, looks like you changed addresses. Can you please verify sending your address? So first step was I verified it was actually the exchange who wrote to me, not a phishing scam. After I did that, I asked them, they said, okay, how do I give this information to you? And they said, just email it. I'm like, no, email is the most insecure system possible. It's so easy to intercept these things. They get bounced over servers all over the world. You don't know what security protocols are managing those servers. I'm not emailing you my ID. So then they're like, oh, here's an encrypted box link. But that wasn't their default. And this is a very well-known exchange that sent this to me. So I was shocked. But you guys, just to summarize this, be very careful with your data. Do not just willingly hand it over to any company that asks it for it. If you have the option, create a unique login for every service you use so those things aren't tied together. And when this stuff comes out, try to use these decentralized identity services. I think they look pretty cool, and we'll definitely be diving into them more on the show. But I will throw this over to you, Jen, for the next story.
All right, something a little less scary. NFT, a 1-year-old DAO that lets you rent out NFTs, has raised a seed round of $1.5 million. So the Ethereum-based project recently facilitated the lending of stoner cats. You'll remember that is the latest project from Mila Kunis and her husband, Ashton Kutcher, where holders rented out their tokens to give others access to a private Discord event. Now, we recently spoke about pawning NFTs, and now people are renting their NFTs out. So I actually think this is cool. I think people are holding onto their NFTs. They don't have anything to do with them except for display them on their Twitter profile or sell them. They're given the option to pawn them, and now they can rent them out. And if we think about the NFTs that offer physical experiences and perks, if you're not going to use those, why wouldn't you rent those out to someone else who can benefit from them? But David, you always fight me on everything fun, so I'm sure you have a different take on this, so I'll pass it down to you.
No, my instinctive reaction was definitely skeptical, but once you read and you talk, you get into the details about, there are actual benefits to these things. Holders get access to services and things like that. And yeah, if you're not using it, it's not insane to try and give access to that to somebody else. However, I have a different sort of contrarian take, and I give me a second here. I'm going to set this up. back when we were still thinking about Bitcoin primarily as currency, one of the big issues that was talked about in terms of valuation is something called velocity of money. So with Bitcoin, for example, if people were constantly spending that money and it was moving around and you could, move it very fast and people could just use the same Bitcoin for multiple transactions back to back, that actually has downward pressure effect on price levels for any currency or unit of account or anything. And so the one thing about this that makes it that has some weird implications is that if you can just rent an NFT to get an experience that you value, that drives down the value of the NFT on the market. So that's something to keep in mind here for NFT holders. It's like you get some secondary income, but maybe you're making actually owning the thing less valuable when you make it possible to rent it out. But on the upside, this is definitely another fascinating addition to just the catalog of kind of composability options and just things that you can do with these assets that it's just like so much easier than the way that traditional finance and traditional assets work, that it opens up all kinds of things like this that is, risky but cool, I'll say.
Yeah, I'll add to that and just say how... Sorry, Jen, go ahead.
No, take it away.
I was just going to say, just on your last comment there, David, about how easy this is. If you compare this to renting things in the meat space world, right? I mean, in NFT world, you're literally just creating a contract, a smart contract that is changing whose keys own this asset and who can use it. And you have a predetermined time period and it's all kind of locked in there. In the real world, I mean, you lend something out, you got to figure out, okay, well, first of all, we got to get some sort of insurance covering all of this because someone could run away with our stuff. What kind of collateral, what kind of identity check? Because that's a huge part of renting in the real world. You got to be able to trust the person to, be good to their word and give you back whatever you're renting. And in the digital world, none of this is a factor. And that's what makes it so wonderful. You don't need to know someone's identity in order to be able to trust them. That was the joy of decentralization of trust in crypto. And that's what makes things like this so interesting, that it's super easy to create a smart contract. You don't need to know who the other person is. You can rent to them and it's all determined by this smart contract. I just think it's super cool. I mean, my first thoughts when I read this article was, it's like with these NFTs, I don't know. I was like, what? So you're blending a picture, like someone's profile picture to someone? Like, that's the weirdest thing. Like, what? But then I thought about it more and I was like, okay, a lot of these NFTs carry a lot of perks with them. You can, meet band members of a band. You can, go behind the scenes at a baseball game. Like all of these things are now experiences that you can kind of sublet, which is kind of an interesting new economy that's starting to emerge. So I'm definitely going to keep an eye on where this sort of thing takes us.
I guess we should move on, but one last thing: NFTs are also part of the decentralized identity ecosystem theoretically. So one kind of maybe iffy, risky part of this is if your NFT is an identifier, you have to build a way to make sure that it doesn't move from your wallet, it doesn't get loaned, it doesn't get rented. So that's just a little wrinkle for those who are interested in the DID stuff. I think we're wrapping up, though. Is it time to go?
I think you're right. The financialization of NFTs is pretty crazy, but welcome to 2021, people. We're in the future. Shit is wild. So thanks for sticking with us on the hash. We'll be back tomorrow with more great stuff. I'm Zach Seward, Naomi Brockwell, David Morris, Jen Sanasi. Hey, check out all about Bitcoin on CoinDesk TV at 3 p.m. Eastern if you're so inclined. And we'll talk to you tomorrow. It'll be great. All right.
See you tomorrow, guys.
Have fun out there.
Oh my gosh.
I